Good morning, everybody, and welcome to another edition of Let's Talk About It. As most of you know, we at Stearns started this series in response to the coronavirus and its impact on the economy, on fiscal and monetary policy, as well as the overall financial markets. My name is Haleh Moddasser, and I look forward to hosting a great program for you today. It's no surprise to any of you that since the onslaught of the pandemic, we at Stearns have been getting numerous questions, both from our clients and thought leaders around the country. Today's program is designed to bring the best of those questions to you, and I'm very happy to have with us Dennis Stearns, founder and president of Stearns Financial Group, as one of our panelists, as well as PJ Williams, the co-chief investment officer and head of global strategies here at Stearns. We're going to tackle some of the toughest questions as it relates to the impact of the coronavirus, as well as the longer term implications for our country and the world. Dennis, PJ, thanks for joining us today. I'm putting you on notice that just because you're my colleague, I'm not taking it easy on you. So.
All right.
Right. Dennis, let's start with you. What I've noticed from talking to clients is that many of our investors find themselves in a conundrum. Those that found themselves getting supremely squeamish at the bottom of the market when the S&P was down 33% are potentially looking to de-risk, while others who've had cash on the sidelines are waiting for that perfect bottom opportunity to get into the market. Do you think we've hit the bottom, or do you think that we're just in the middle of a bear market rally?
Yeah, very good question, Holly. Hello, everyone. I think, the first thing to answer that is that most bear markets don't have just one bottom. They have two or three bottoms, multiple bottoms. And so that's the danger point here, is that the stock market's been doing pretty well, bouncing up off the lows in March. But history tells us that, we're likely to have a second bottom somewhere along the way here. And so this kind of gets to the issue of even trying to chase bottoms, which we have found over decades of experience is practically impossible. And so, the analogy here is back to 08, 09. In 2008, coming into the Great Recession, we had tremendous upheaval, uncertainty. We had big government stimulus rescue programs, although they did not happen at nearly the magnitude or the speed of what we have going on right now, which we'll get into a little bit later. Then, we were nibbling along in the fourth quarter of 2008 and into the first quarter of 2009. And in first quarter of 2009, we hit the nasty second bottom. And so the fact that we had been nibbling in, a year or two or three down the line, we and our clients were fine. And if we had just been waiting for that perfect time, we might have still been waiting 3 years later. So you've got to be very careful about the bottom watch. And the other piece of this that I think is extremely relevant, and we have a lot of information in our chat that's coming out, our written chat that's coming out this afternoon, that this is the first self-induced government recession in U.S. history. Let me repeat that. First self-induced recession in U.S. history. And so the playbook for this one hasn't even been written. So, at this point, we're taking in a lot of really good information from our research sources, from our extended network, and there's a lot of opinions out there. Frankly, 98% of them are probably not worth the what they're written on. And so, we're trying to sort through all that and make the best decisions as we go. And the reality is that some of this just gets back to good old-fashioned, what are your facts and circumstances, in terms of your future financial roadmap and your financial resources, and what's going to allow you to sleep well at night. And, you're getting back to fundamentals of risk, because we do believe this is not going to end with a nice, clean finish. And again, we have a lot of information on that in our chat coming out this afternoon.
So would it make sense to you at this point, Dennis, to have potentially different investment buckets, maybe some money set aside in working capital accounts just to cover living expenses for some period of time, and then other money potentially to be more aggressive with an eye toward growth? What's your thought on that?
Yeah, I mean, this is, again, a little bit of a replay in a different way of 08, 09. And so we are definitely advising everybody, have enough cash to ride this out if it turns out to be longer than we anticipate. And but it's, again, dependent on facts and circumstances. So, we were consulting with one of our dentist clients the other day, and his job is fine and his wife's job's fine, and they're rock solid, and so they don't need quite as much cash as maybe somebody else would need. And so again, I think it's very situation specific on the cash reserve. On the regular portfolio, we do have some clients who are just fine with allowing us to do normal portfolio moves dependent on their risk level. And then we have a few others, and sometimes the life partners, husband and wife or whatever, aren't agreeing on this within their own household. But we have some others who want to separate a smaller bucket of money to try to take advantage of some opportunities. And just in the last 3 days, we've identified a whole host of interesting opportunities. And some of the valuations are compelling and historic, and some of the other valuations are not all that compelling. And this is not quite like coming out of 08, 09, where we looked at every company. We do an analysis of PepsiCo, and we do an analysis of Johnson & Johnson and Microsoft, and every single company was so on sale that it was a Michael Jordan layup to lean into those. This one's a way more nuanced situation we have going on.
Agree with that. Some sectors are clearly doing better than others in this environment of social distancing and working from home, and others are just doing terribly. For example, oil right now. So energy might be a place to look, maybe financials.
Yeah, and PJ is going to get into it in a little bit around the interesting thing going on in the tech sector. Microsoft, which has traditionally been one of our top 3 holdings in our firm, when you look underneath the hood of all the things we're investing in, is one of the few stocks that was actually up in the first quarter. And so, in some cases, this goes back to value investing 101, where the things that have done the best may not be the things doing the best in the next year or 2 or 3, but some of those tech stocks are definitely part of this new economy. So again, we have a very different playbook than we might have had 10, 20 years ago.
Agreed. So just quickly, for those investors that have cash on the sidelines and are maybe dollar cost averaging or waiting for the bottom, even though good luck with that, where do you suggest that they park their cash? I mean, in this interest rate environment, where do you go?
Yeah, well, and so traditional money markets were under some pressure several weeks ago, but then the Federal Reserve stepped in and, as PJ will get into, basically went into shock and awe mode. And so it is very unlikely that we're going to have any problems with money markets. It's very unlikely that the banks are going to have problems. But I say that, and this Paycheck Protection Program being rolled out right now under the CARES Act is really very difficult. I mean, a lot of our small business clients are having a heck of a time, and the banks are having a heck of a time. So we, in an abundance of caution, moved a lot of our regular money markets to treasuries, to U.S. government short-term treasuries recently, and sacrifice a little bit of yield, but rock solid no matter what happens. Now we do have some enhanced yield types of things we can invest in, but again, it's facts and circumstances whether it even makes sense for somebody to try to go out and grab an extra 0.5% or whatever of return short term until we're pretty sure how some of these C19 scenarios play out, which we'll get into a little bit later in this webcast.
Yeah, I think the moral of the story here is we're looking for safety with cash. We're not looking necessarily to make money. And for our viewers, what Dennis is referring to is that we actually went away from prime money market, which includes some exposure to commercial paper and corporate, and went directly into 100% treasuries. So yes, we gave up a slight bit of yield, but we found that it's just a safer place right now in this environment.
Yeah, we want to pick our spots for risk, and we want to have some things that are rock solid just in case this whole scenario goes a direction that nobody's expecting. But then take our selected, calculated risks in other places in the portfolio.
Exactly. Thank you, Dennis. PJ, I wonder if you could talk to us for a minute about the enormous fiscal stimulus that the Fed is throwing our way. I know that we initially had a $2.3 trillion package. The Fed announced yesterday morning another multi-trillion-dollar package. And all of this is intended to help the economy weather the storm until we get past this pandemic. Do you think it's enough? And how do you think this is going to play out?
Yeah, thanks, Holly. I think taking a step back to what you and Dennis both just alluded to when you're talking about the credit markets. If we go back about 4 weeks to early March, we really did see them begin to seize up. Whether it was the overnight lending between banks, it was short-term commercial paper. We saw an increase in yields across the board. People were not willing to lend intrabank, and companies were having trouble rolling their commercial paper. And so that was kind of maybe the first catalyst for the Fed to take quick and immediate and very strong action. And that's what we saw back on an emergency meeting that they had the weekend of March 15th, when they announced that they were cutting interest rates to zero, and also announced a $700 billion bond buying program. That was just the first round. That was an initial attempt to, again, get liquidity flowing back and forth between the banks and begin to think about, okay, what's next? And that was the money market funds. So we only had to wait a week before they announced what is essentially amounts to QE infinity. And QE stands for quantitative easing. You may have heard that back coming out of the Great Recession. It's essentially just saying monetary stimulus, where the Fed is stepping in to be essentially a lender of last resort, willing to buy bonds from investors who may want the liquidity. And so at that time, around March 23rd, they announced that they were going to buy corporate bonds, and they were going to start buying exchange-traded corporate bond ETFs. That was the first time they've ever done that. They did not do that back during the Great Recession. And they did not really put limits on this. They essentially came in and said, we have the economy's back. Now, when they say they have the economy's back, that's first and foremost what we want to focus on. We want to focus on the small businesses. We want to make sure that people are still able to get access to credit that they need and deserve. But what the next step is in all this is, where do we go from here? So it's nice to provide all that liquidity, but it needs to get to the right places. And I think that's what we are continuing to look at and review is, do we think that a massive amount of stimulus is going to go to the right places? Along the way, the last couple of weeks, they've announced multiple new lending facility programs. It's pretty much an alphabet soup of acronyms. You probably heard TARP was something thrown around with the big banks back during the Great Recession. There's a bunch more that they announced in recent weeks. And then Holly alluded to it, but a big surprise is what happened yesterday when they announced another $2.3 trillion of essentially lending capacity to backstop municipalities, small businesses, and they announced yesterday they were going to buy below investment grade corporate bonds, so junk bonds and junk bond ETFs. So again, the Fed, who back during the Great Recession talked a lot about buying treasuries and mortgage-backed securities from investors, now they're talking about buying corporate bonds, corporate bond ETFs, and now we've proceeded to start buying high-yield bonds and high-yield ETFs. The reason that that is a big step for them, and this is something that Stearns has talked about for the past 2 or 3 years, is that during the last decade, many companies have binged on cheap credit. Interest rates being really low, banks being willing to lend, balance sheets have gotten pretty leveraged in many parts of the U.S. economy. And so as a result of that, you have companies that may not be able to withstand even a small downtick in cash flow, and they might miss interest payments. Well, when this happens, the rating agencies, who I believe are going to be a lot more critical and quick to react this time around, having been not done that back during the Great Recession and definitely been ridiculed for it. I think they'll be a lot quicker to act. And as companies get downgraded into high yield, that's going to cause significant issues across the investment markets for certain mutual funds or certain exchange trade funds that can't hold junk bonds. And so the Fed stepping in to say, we will buy what are called fallen angels. Those are investment grade corporate bonds that fall into junk status. That's a big step for the Fed. And so from a liquidity perspective, the Fed has done, I think, everything that they could do up to this point. I think they've staved off a liquidity issue at this time. But as we'll discuss, there's still a long way for this virus to run and for how the economy gets back to where it was.
Thanks for that, PJ. It really is an unprecedented amount of money that's being thrown at this problem. But at the end of the day, if we can't get consumers back to work and back into their hairdressers and back into restaurants, we're going to have at least a significant number of small businesses go under. So talk us through a little bit what might happen with small businesses who may miss their rent payments, may have to ultimately let their staff go, may ultimately go under. How do they get back on their feet? Do you think there will be any concessions made for these small businesses in terms of getting loans once we get past this with now, bad credit ratings essentially?
Yeah, and I think we discussed this 2 weeks back. Coming out the other side of this, unfortunately, there are going to be a lot of small businesses that don't make it. Even with the PPP loans that may be forgiven, if you are in an industry where when we do open up the country again, if people don't flock back, maybe people don't want to go to small restaurants that have tables right on top of each other in some of the big cities for a while. Those restaurants, may not come back. You hope that people, both the owners and the employees, can have support during this time, and that is what the fiscal stimulus that Congress has provided has done, and what the Fed is now starting to do for small businesses. But until we see the other side of this, it's really hard to say what's going to happen to those businesses. I think there will be concessions across the board from many landlords in terms of allowing a restaurant or a small retail shop to miss a payment or two. But at the end of the day, if their customers don't come back on the other side of this, that's ultimately going to be the deciding factor on whether these companies make it.
Yeah.
I'm sorry. Go ahead, Dennis.
Yeah, no, I was just going to add that every single day, sometimes 3 or 4 times a day, we're hearing stories about some of our clients actually supporting the small businesses that they like the best. And so this is one of those situations where if somebody's been doing a great job, a restaurateur or a cleaning service or whatever it is, there's folks out there that are continuing to pay them even though they may not be doing services. And there's even all kinds of Kickstart programs, and heard about one of those yesterday with just a fabulous kind of niche-y bookstore that has served a function in a particular city. And so our clients are supporting that. And thousands of other people are supporting that with $100 donations. So, again, I think this will be one where some of the better businesses who have really been performing well will shine. And unfortunately, some of the other ones will kind of fall by the wayside. And, we did a program with an economist earlier this week for the North Carolina Technology Association. And his point was, this is the United States of America, and creative destruction is what we do. The rolling of businesses, careers, changing them, that if it ain't broke, break it, fix it better. And so this is the way we've always been in this country. It's actually accelerating during this pandemic. So, some things will be the same coming out the rear end of this, other things not so much.
Yeah, I love seeing the spirit of generosity as well as the entrepreneurial spirit that we're seeing where, an alcohol distillery is suddenly making disinfectant and where a car manufacturer is suddenly making face masks. It's really heartwarming to see people coming together. But I do worry about some of our smaller businesses and am encouraging our viewers to continue to support them so that they can get through this.
Yeah.
PJ, let's talk a little bit about the investment markets, if you would. I know before the pandemic, many people thought that technology stocks, the FANG stocks, were completely overvalued, and maybe we were actually in another bubble. And it seems that obviously, given our remote working situations, that technology stocks are faring a lot better than others. Tell us how you see tech stocks faring going forward.
No, happy to, Holly. And you mentioned the FANG stocks. So that's Facebook, Apple, Amazon, Netflix, and Google, which is now referred to as Alphabet. You think about what we are all experiencing right now, self-isolating. Well, Facebook, people spend all day on Facebook. Amazon, now you can't go anywhere, so you get everything shipped to your door. Apple's one we'll talk about. Apple's probably of the ones I just mentioned, Apple's probably has had the most issues from this because a lot of their supply chain is sitting over in Asia, and so that's been hindered by this coronavirus. Netflix has had a great year. I'm sure many people that even said they would never subscribe to Netflix have signed up for it, just trying to find something to do to occupy the time during the day. And then Google, a very asset-light company, is another one that you would expect to fare well during these times. So tech has held up very well in many areas. I think what we think about going forward is separating the asset-light companies from the ones like maybe an Intel, an IBM, Apple, that's going to require more supply chain management. And that's what we're really going to have to see is, do we get the full, how far do we go, not just in the US, but around the globe with deglobalization and onshoring of supply chains? And what does that mean for profit margins? So again, tech has held up well. I think there's many pockets of tech that will continue to do well, especially healthcare related tech, digital health, many people call it. So tech for now has a bright future, but again, it's held up better. So it might not have the pop ability coming out the other side of this that some beaten down companies and energy or financials might have. But to go bottom fishing right now, it still may be early.
Let's see. It looks like we're having some technical difficulties. Let me see if I can get the sound.
Yeah, so Holly, it shows that you're muted right now. Don't know if that's from your end or from Bill's end.
Is that better?
That's better.
All right. Sorry about that, technical difficulties. PJ, talk to us for a minute about some of the other asset classes. For example, gold, private equity, real estate. What's your feeling on those going forward, given what's happened with the pandemic?
Yeah, so gold's had a good year, unsurprisingly, and during this environment. And gold's really, going back to the second half of 2018, has had a nice run. Coming into this year, so if you look back to late 2018, all during 2019, Lots of central banks around the world were buying gold. In some parts of the globe, they're looking for things to invest in other than the US dollar. And that was providing a tailwind. And now what you have with gold, and it's kind of going up in conjunction with the US dollar this year, is what people perceive to be either, a asset that you run to when you're scared. So that could be one reason why people are buying gold. But another reason is that when you see these deficits building up, the expectation is that at some point it will spark inflation. Now, I will put the caveat that we saw we blew up our deficit back during the Great Recession. We have not seen inflation as a result of that. As a country that can print its own money, and as a country that can issue debt to not just within the U.S. but around the globe still, and people are willing to buy it, that provides us with an opportunity to have a currency that can hold up better than others would in this type of situation. So gold has done very well, and looking out to the future, I think it's positioned to continue to do well in this type of environment. Turning to real estate. Real estate's going to be real interesting. You're going to look across the spectrum of the different real estate assets, whether you're looking at multifamily, you're looking at office, you're looking at retail, industrial. Each one of these is going to have a different pathway going forward. Retail especially was struggling coming into this. This is not going to help. When you think about big box stores, when you think about mom and pop retail shops, this is definitely going to be a crisis that's going to further deteriorate many parts of the retail market. For multifamily, we're going to definitely see cash flows decline in the short run with tenants not paying their rent. Now the question will be, on the other side of this, what does unemployment look like 6 months from now? We've seen staggering unemployment numbers the last 3 weeks, unprecedented when you think about 16 million people filing new unemployment claims over a 3-week period. I think the previous high we've seen over a 3-week period was back in 1982. We had 2 million. Just to put in perspective what's occurred these last few weeks. But a silver lining that you can see in the data right now is that a majority of these unemployment claims are for people that have been temporarily laid off or furloughed. Too early to tell. Do those turn into permanent layoffs? We hope not. But the question is, 6 months from now, are those people back at work? Are they paying their rents again and getting the cash flow going again for multifamily? Office is another one where I think it's too early to tell what's going to happen, because coming out the other side of this, what do companies do in terms of making their decisions on the expense side for office space? We have all learned how to, if you work in an office environment, for many companies, learn how to work remotely, interact with each other, do things via Zoom or GoToMeeting. And so do companies need less office space? I think that is TBD, because I think people do enjoy the interaction, but at the same time, if you're trying to cut expenses somewhere as we come out of this, that might be a square footage of your office space. And one last area of real estate I'll touch on is industrial. You think of Amazon warehouses, logistical operations. Those are going to do very well during this time, and will probably continue to do well as we get a economy that focuses on things like Amazon and people having things shipped to their house and not wanting to go out into huge crowds. So those types of industrial properties should continue to do well in cash flow during this environment.
Great, thank you for that recap. It definitely highlights that we may see some long-term systemic changes as a result of the pandemic and, just this remote working environment. And I'm hearing a lot of people talking about how, they miss going to restaurants and to the movies, but it feels a little bit more wholesome to be eating at home more, to be spending time with your families. So it's definitely going to teach us a little something going forward. And I expect that we might see some long-term changes as a result. Dennis, I'm throwing you a hardball now. The elephant in the room, which is we are spending trillions of dollars of money, and going into this pandemic, it was expected that we would have about $1 trillion deficit in 2020. And as we all know, the nation's debt is hovering around $22 trillion. To date, we're spending a minimum of $6 trillion extra on this pandemic, and I expect that number is only going to rise. So basically, where is the money coming from? Are we just printing money, and are we headed toward a monetary, an MMT scenario?
Yeah, good question. And so, I think that the latest moves in the last few days from the Federal Reserve have upped the ante on this to an incredible level. And it is just amazing, when everybody said, "Oh, the Federal Reserve's out of bullets," and they ended up bringing an aircraft carrier to the party, and that doesn't count the fact that there's a very good chance within the next month or two or three we will see a stimulus program. We had this back in 08, 09. We had the rescue program in the fourth quarter of 08 for the Great Recession. Then we had the stimulus program in early 2009. And so chances are very good we'll have something like that here too. And so, I think that it gets back to this self-induced recession, and there is a possibility that the government will go too overboard. Now, are they there yet? We're not sure. And, again, I know a lot of people worry about the level of our debt. Some of that remains within our control as long as we are the mattress of the world. And right now, we are the mattress of the world, where the safety net and the currency is significant to help us be able to finance all this at very low interest rates. If that were not the case, we'd be in a world of hurt sooner rather than later. And so some of this may not come back to bite us for, who knows, 5 years. But it's definitely shortened the time horizon when we're going to start being more concerned about it. Bill, pull up that slide. So this slide will be in your written chat this afternoon, and it's Goldman Sachs' latest prognostication about what the overall economy will look like, and then by sector, because it's definitely, as we've already touched on in this chat, different sectors having different issues. It's a little bit of a busy chart, but the piece that I think is kind of interesting at the top, you can see the overall, this chart right up here where we've got the stimulus at the top, that circle in blue is around. That is the first round of government stimulus, which was the CARES Act and the things before it. That stimulus on the top end, supporting the significant decline on the bottom end, is now being supplemented by more. And so the more is effectively, going to look like that, and possibly even like that. And so the real question then is, okay, if it's done well, which again, early signs are that the cavalry rode out of the fort to help the homesteaders and immediately galloped off a cliff. Again, I think the Paycheck Protection Program is not indicative necessarily of all the things that are going on. But if the more is done in a really well thought out fashion and executed well, then those blue lines above will really support the bottom line. And that red line that you see, that red line will very likely take a different path. And that different path could easily be something more like that. But it's going to be very specific, as we said earlier, to different industries, different sectors, consumers. Back to your point, Holly, are they even willing to risk it and go out there? So we also have in our chat this afternoon some really interesting texture around Germany's plan. And in typical fashion, the Germans are thinking this through at a very deep level. And so we're going to have our own version of that, restart the economy, the middle game and the end game. And, I was on a call with an epidemiologist yesterday, infectious disease person, and they said, whether this chart on the bottom end, forget about those blue lines in terms of fiscal stimulus, but on the bottom end on the recovery is going to somewhat depend on how well we execute the middle game and end game in terms of restarting the economy. And there are a lot of experiments going on in the world. I mean, China right now is one major experiment, but they have a little different type of economy than we do. And so, our own version will need to be well thought out and well executed.
Yeah, thanks, Dennis. I'll say that obviously we have to figure out the virus, have good treatments, potentially have a vaccine. But I know many people who feel like even when they get the green light that, it's safe to go out and you don't have to exercise social distancing anymore and that you can actually travel, we're going to have to get the consumer confident that they can actually do that safely. PJ, why don't you talk a little bit about your views on that? How do you think that's going to play out in terms of the way that you're managing portfolios?
Yeah, I think when we're looking at this, as Dennis just alluded to, it really the first thing to focus on is the direction of the virus, the duration really of the requirement that we continue to do social distancing, that we continue to avoid public gatherings. So that's the first thing, and no one knows right now. We've seen some positive data coming out of New York. It's been countered by some maybe some slippage in New York, other areas around the country. So that's what we'll be watching over the coming weeks and months probably. Is can we get to a point where we feel that the worst from the first wave, again, nobody knows if there's going to be a second or third. We all hope not. We all hope that there will be treatments and a vaccine. But for the vaccine especially, we know that's 12 months plus out. Hopefully a treatment can come along faster. Hopefully we can do better with testing, because that's what we see as a big kind of one of the first things that has to happen before opening the economy is the ability to be rapid testing. Like Holly said, many people will be worried about going back to a stadium, a sporting event, if you don't know that everybody there has been tested. So there's going to be pockets in the economy that don't restart at the same pace. So first the virus, we need to figure out where that is headed and the duration. And then the next will be the economy, and certain parts will restart faster than others. Once you get there, you'll be able to look further out to the future. Because when we're investing in the markets, especially the stock market, you're looking at what do future earnings of the companies I'm investing in look like. Right now, with many companies not providing guidance and their companies just not knowing where things are going to stand because of the unknown duration of this event, it's hard to look too far out in the future. And so that's why right now at Stearns, as Dennis alluded to, wanting to make sure that every client's set up on the financial side with, okay, do I have enough cash reserves to weather the duration of this? But then with my portfolio, I need to remain diversified. Bonds have held up during this period of time. Stocks have had obviously a very rough March, but have recovered so far. But again, Dennis alluded to, don't get too confident in that yet until we see more stability, especially on the virus side. The economy will come back after the virus threat begins to relieve itself. But again, it'll be, as Dennis said, starts and stops in certain areas. And the speed at which different sectors come back will definitely vary.
Yeah.
Yeah, and I was just going to add, PJ, that I was talking to a CEO of a company yesterday in Chicago, and he was talking about how, they're getting some nice weather and people are starting to come out and congregate in the parks and have soccer matches, and that in the process of all of that, it has really created some problems, and the governor and the mayor and the police are shutting those things down. And so some of this is dependent on our ability to, continue going. And so, the fact that the death rate forecasts have been coming down and some of the other things are coming down, there's people who say, oh, the worst of it's over. And that's actually counter to what they should be trying to do, which is, let's make sure that we not just flatten this curve, that we squash the curve.
That's right. And also the curve is different in every different part of the country. And so it's, it's not going to all happen at once. So good news out of New York doesn't necessarily mean that it's good news in Chicago. And we all need to be mindful of that. We're just about out of time, but I think the big picture message here to all of our clients is that this situation is is very dependent on your personal situation. So if you're approaching retirement, or if you're a retiree and living off of your investment portfolio, please don't hesitate to reach out. It may be a good time to update your financial plan or talk specifically about your situation. In the meantime, I want to thank our panelists, PJ and Dennis, for joining us today and offering your perspectives. And to our audience, I hope that you found this session of Let's Talk About It useful. Please continue to take precautions, take care of yourself, and we at Stearns are wishing you and your families good health and some good home-cooked meals. We'll see you next time. Thank you.
Thank you. Thanks, Haleh.
Thank you.